I was going to show you this real quick, Garrett. So at the end I went back and finished watching the end of your video. And when you were talking about Monday, and then you were drilling down how you feel like normally you would just not be able to focus on it. So this is kind of how you had your chart laid out. So even though the narrative is, as you say, shit, I just want to show you something. So obviously this is the 1 minute chart. Here's your 9:30 open. And so, not that a guy would want to trade this or would trade this, but to the to the point of um, to the point of the market is going to go where the market's going to go. How it gets there, whether it's this or it's this, that's what's up in the air. But the market is still going to go where it's going, just because it does it this way versus one little retracement and then there doesn't change the fact that this is where it's going. So that being said, 15-minute chart. This is what you're looking at. Now, let's ignore what you're talking about as far as why it doesn't need to or why it wouldn't. Again, that's kind of a market maker question. Why doesn't it want to? Well, they don't want to. Evidently, smart money has accumulated an incredible amount of longs here, and they don't need to accumulate any more. And so once there's enough, they run it. So that's simple as that. But and I say I'm sure it's not as simple as that. That's just how I view it, to where I'm not looking at it going. It doesn't skew me from looking at, but what is it actually? What is the market structure actually telling me? So on this day here, whether you want to trade in this type of environment or not, it doesn't change what the market's doing. So if you add this, you could call this, yes, there's wicks here, but whatever gap you want to use, this is an old opening range gap. So whether you want to look at it as an implied gap, wicks are gaps. So however you would potentially want to use this, you could use it either way. You could just go, I'm just going to, well, let's say, I don't know what type of gap it is, but wicks are gaps. So however you want to use it, for trading of Monday, so this is 9:15, and the reason I say you could use the gap or the wick, you can use if we're using regular trading hours, and you have what it showed on regular trading hours, even though you aren't seeing a gap, wicks are gaps, and there's still a gap there. So if you're not going to go to electronic trading hours and use that at all, you can still have to look at it and go, that's that's a gap. So if you, because we're in electronic trading hours now, so whether you use the wick as it being a gap, or you can see that you don't necessarily need to go to electronic trading hours, but there is a gap. So if I was trading this, I would probably use it like this, body to body, and treat this like a volume imbalance. So there's a couple different things that ways that you could look at it. Again, not that you want to trade this, but you could trade, say it opened below above the volume imbalance, closed below it. We have a discount opening range gap that we're trying to get down to the lower quadrant or the middle of it. So if you have this regular trading hours wick on here, you could look at this as anything above this as high as I want to, as high as I can get it, would be a sell short to 15-minute inversion fair value gap regular trading hours. So even if you don't want to use that, or you want to use, or you could use, I can't see, my hands in the way. If you took this and go, actually, let's just do this. Let's clear this and go back over here. And since there can be multiple ways you use it, there's a gap here. This is an old 930 open. This is a close. So even though you have these wicks here, let's just use the wick. And rather than using quadrants, we'll go, okay, we're going to use this wick. And we could, if we wanted to, call it the low of a bearish order block, because this has been traded through. Nonetheless, what I'm trying to bring your attention to is that here's an old opening range gap. Regular trading hours. Closes below it. So you could view that, I would view that as extremely bearish. Two, at a minimum, we have this PD array down here, like you said. The other thing that we have is that you would have here is that technically there's a green candle right here. So this up close candle before the down move, technically this so regular trading hours 15-minute PD array, regular trading hours 15-minute PD array, below price, price opens 9:30. These two candles your opening range. $10 takes low out, trades above. This is equilibrium of that, down to the inefficiency. So again, not that you would want to trade that, but it's the same stuff. Here's the high of here's your swing high and your swing low all the way down here. And your equilibrium is right here for your 15-minute swing high and swing low. So before, well, let's not worry about that. Well, we do know that from a swing high, swing low perspective, that one thing that the market technically sometimes likes to do is get below equilibrium before it rallies to take out the upside. Here's your two swing lows. But if you, again, not that you want to trade this, 9:30 open, first presented fair value gap. Let's go back to 9:59. $10 opens. $10 opens, takes down the low of our session liquidity first, trades above equilibrium, back up to mean threshold or consequent encroachment of that opening range wick that we outlined, which I don't need to say anything about whether you throw a OTE on here, and then it goes down to the inefficiency that was below price. So even though the narrative is this, you can still read the price action.